Hi, it's Ed Butowsky. So when I do these weekly videos, I try to keep them informative, educational as much as possible. And this one in particular, I want you to listen in very carefully to. It has to do with something that we talk about in our business, volatility. Volatility affects you not just psychologically, but also mathematically. So what I wanted to point out is that both of these portfolios have rates of returns of 10%. But this one has a standard deviation of 15, which means that it's more volatile than the one that has an 8. And you can see that psychologically, the more volatility, the more nerve-wracking it becomes for you. And when you have less volatility, which is half of this, which is 8, you have less unnervingness, less sleepless nights. And also mathematically, in this case, if you had $1 million over a 10-year period, you'd have $325,000 more dollars. That's because you missed out on the downside pressure of the returns of the stock market. And when I say 10 and 15, that is the stock market. So if you ask anybody, if you ask your current advisor, if you had a rate of return of 10, what is a good standard deviation? Most likely, they're going to say 15, which is not correct. And you can control your standard deviation by having low correlation on your assets. And that's something that we really focus in on at Chapwood Investments. But I wanted to point out that you have just as good a chance of making 40% in the next 12 months as you do losing 20% with that portfolio. And here you have just as good a chance of making 26% as you do losing 6%. You would have $2.158925 million from $1 million. You'd have a double, and over here you wouldn't have a double because you participated in the volatility. So again, a higher standard deviation is not something that's desirable. You want to have a low standard deviation, and you can see here that portfolio A and portfolio B, the wider the spread, the more variance there is on the portfolio. You want it to be more narrow, like portfolio B. So not just psychologically, but mathematically, it works for you. If you want us to do an analysis for you, we'll be happy to do it on what your current portfolio historical rate of return and standard deviation is, and how to make that standard deviation number lower.